Microeconomics, chapter number 8, concepts of cost and cost curves. So chapter number 8 in the microeconomics, we are going to deal with the concept or ideas of cost and about the cost curves. So there are different types of costs that we study in modern microeconomics, and from this concept of cost we are deriving the different types of cost curves that we shall discuss in this chapter number 8. So in the previous chapter, that is chapter number 8, we have discussed about the law of returns. So returns to scale, returns to factor, that we have discussed in the chapter number 7, that is the previous chapter. So this production condition, that is, returns to scale or returns to factor, they also, command a degree of, supply of goods. Means that this production condition also determines the supply of various goods and commodities. So what we will do in this chapter is we will carry forward this analysis of the forces that is determining the supply of goods, and we shall explain how the cost of production of the firm will change with the change in its output. So we shall try to explain how the cost of production of a firm will affect or will change, will alter the change in its output. So depending on the cost of production, how will the output change? That we shall try to explain in this chapter. And then we shall also see the cost-output relation. So here it is discussing about nothing but the production cost. So how will this production cost change the output of a commodity? So we have one term that we need to discuss when it comes to cost output relations. So cost function, that is cost function. So what is a cost function? So the relationship between cost and output is called the cost function. So cost function is nothing but the relationship between the cost and the output. So how will the production cost determines or change, alters the amount that is supplied? That is the cost function. And again further, this cost function depends on the production condition that we have discussed, that is returns to factor, returns to scale, and also the prices of the factors that is used for production, maybe land, labor, capital, all those. It also depends on the prices of these factors. So this cost function further depends on the production condition as well as prices of all those factors that is used for production of goods. That is why we can say that this cost of production, the cost which is incurred to produce a particular commodity, is the most important forces governing the supply of a product. So it is the cost of production that is considered important, or it is important forces governing the supply of a product. So depending on the cost of production, a producer, a firm will supply the particular product accordingly. So what a firm does is they will try to minimize the production cost. So minimization of the production cost. So a profit motive firms or producers will try to minimize the cost of production. That is why we can conclude that producers or products are produced at the minimum cost, a minimum cost of production. So that is the brief introduction for the concept of cost and cost curves. So having discussed the introduction, we shall go forward to understand some of the concept of cost. So first concept that we have in the cost is accounting cost and economic cost. So what is the difference between economic costs and also accounting costs. What are their meaning and what is the difference between these two cost concept, accounting cost and economic cost? So when an entrepreneur or when a producer produces a commodity, what he does is he undertakes an act of production. So in that act of production, he has to pay prices for the factors which he employs for production. So he pays wages to the laborers, prices for the raw materials, fuel and power used, rent for the building he hires for production work, and the rate of interest on the money borrowed for doing business. So all that he pays for the using of factors, various factors that an entrepreneur has to pay when he undertakes production activity. So all these are included in his cost of production. So all that he pays in undertaking production activity is included as the cost of production. So what will an accountant do? An accountant will take into account only the payments. So accountant will take into account only the payments and charges made by the entrepreneurs to the suppliers of various productive factors. So when it comes to economic cost, it will only take into account the charges or the payment made by the entrepreneurs or producers or the firms to the suppliers of various productive factors. That is accounting cost. So what about economic costs? So in economist view of cost is somewhat different from this accounting cost. So it generally happens that entrepreneur invest a certain amount of his own money capital in his production business. So if the money capital invested by the entrepreneur or producer or by a firm in his own business, if that is used elsewhere, if that is invested elsewhere instead of investing in his own business, it would have earned a certain amount of interest for that individual. So if he has not invested for himself and has invested elsewhere, it would have earned him a certain amount of interest or dividends or profit. So moreover, an entrepreneur devotes time to his work. He dedicates his time, his effort, and then his energy, and contributes his entrepreneurial and managerial ability for his business. So if the entrepreneur had not set up his own business, he would have sold his service to others for some positive amount of money. Therefore, economics would also include in the cost of production. So in economics point of view, or in economics cost, it would, in the production costs, he would include these two: the normal return of money capital that is invested by the entrepreneur himself in his own business, which he could have earned if he had sold his service to others, and also the wages or salary he could have earned if he had sold his service to others. So both is included when it comes to economic costs. But when it comes to accounting costs, he's just taking into account the payments or charges made to the suppliers of productive factors, not for himself. But in economic costs, we are taking into account the amount of profit dividends that an entrepreneur could have earned if he has invested elsewhere and not in his own business. So that is the difference. So related to that, we have explicit and implicit costs. So by going by the definition, explicit, the actual money expenditure which a firm incurs to pay to suppliers of factors used for production. So this explicit is similar with accounting cost. It is the expenditure which a firm gave to the suppliers of factors of production only, in the form of wages, interest, rent, for the suppliers of factors of production. So that is explicit cost in similar with the accounting cost. What about the implicit cost? The cost of self-owned factors which are employed by the entrepreneurs in his own business. That is implicit cost. So the managerial ability, the entrepreneurship, and then the time, the energy, the effort that he puts in his work is the implicit cost, or the cost of self-owned factors, which if he has invested elsewhere, he could have earned some profit or dividend. But since he is investing in his own business, he's not getting that. But that cost is the implicit cost, the cost of self-owned factors which are employed by the entrepreneurs himself in his own business. So that is the explicit and implicit cost. So we have just explained what is explicit and implicit cost. So as I have mentioned, explicit cost is similar with the accounting cost. And so when we talk about the economic cost, we are including both explicit plus implicit cost. So it takes into account this economic cost takes into account both the explicit and the implicit cost. Therefore, economic cost equals to both the accounting cost plus the implicit cost, because accounting cost is similar to the explicit cost. That is why economic cost equals accounting cost plus implicit cost. So from this, we may point out that the firm will earn economic profits only if it is making revenue in excess of this total accounting and the implicit cost. So a firm will earn an economic profit only when it is earning in excess of this accounting cost plus the implicit cost. So economic profit can be given by total revenue minus economic cost. So economic profit is nothing but the it is nothing but we have to minus economic cost from the total revenue, because economic cost is both accounting cost plus implicit cost. Because of that, a firm earns economic profit only and if it is making revenue in excess of the total accounting and also the implicit cost. So that is all about explicit, implicit cost and accounting and economic cost. So both the the accounting cost, economic cost, and also the explicit and implicit costs are related.